Good morning. Welcome back to the Clubhouse Insider. It is Monday, February 9th. Last week gave us something that we haven't seen in a little while, a meaningful rate improvement driven by actual data. So on Thursday, new jobs and labor market numbers came in softer than expected. Job growth slowed, which wage pressures cooled, and it signaled to markets that inflation may not be accelerating the way some were fearing. When labor data softens, bond yields, like this 10-year Treasury. Okay, we'll look at the last couple days here. So when labor data softens, bond yields typically fall, and that's exactly what happened. Treasury yields dropped Thursday, and mortgage rates followed, which created a nice late week window for buyers and anyone looking to refinance. So you can take a look at the chart here, and you'll see this little drop. So we were kind of going the wrong way, peaks and valleys, up and down, where we got 6.1. We saw for a little while there rates averaging just a little bit better by about 15 basis points. So we're not at major lows, but we still are very much at a couple year lows here, following a lot of what the experts have been predicting. So FHAs, VAs still in the fives, conventional still a little room to run. On that Treasury, if you want to see rates really dip into the fives for real, I think that we need to see a 3 on this number right here on the 10-year Treasury. I've been asked a lot what to follow lately, and bonds and different things. The 10-year Treasury is the closest thing that you can watch the ebbs and flows, the ups and downs, to see what is going to work there. So last week, jobs, good data for the mortgage market, and we saw a really nice improvement. So that was Thursday. Friday, while rates had improved, the stock market and the Dow Jones hit a record high of 50,000. So first time ever that the Dow Jones made it to 50K. So strong signal of overall economic confidence and the risk appetite in the markets, which people, that's what you're always trying to guess. And all these traders are trying to foresee what's going to happen next. So what does all that mean? The labor market is cooling just enough to where it's going to help mortgage rates, and it has. Remember, they always price things in first going forward. Stocks are strong. That means confidence. Rates are not collapsing, but they are presenting windows. This chart really kind of shows that, right? Up and down. So there's a window. Here comes another window. And so if you're sitting in the high 6s or 7s at an interest rate, and especially depending on what type of loan product you have, or if you're in a temporary buy down, and that's going to adjust because that's what a builder puts you in, this is the type of environment where you should at least review your numbers. Most experts still expect rates to stay within this range unless we see a major economic shift. So 4 and 5% rates are still not that likely in the current forecast. You can see here, just typing in news, and there's opportunity for cuts. There's room for cuts, but nothing is guaranteed. So the market isn't giving away super amount of free money, but it's giving these windows, and you can absolutely create savings. So if you want to know whether this window applies to you, please reach out. Please comment on the video as well. I'd love to hear people's thoughts. Let me know if you think I'm crazy, or if you like some of these updates. Let's hear from you, and then if we can help you run numbers, let's see if it makes sense. So have a great week, and hopefully you enjoy the great weather. At least here in Texas, we're out of the cold and into the warm again. So have a great week, everybody.